You get your paycheck, you look at the number, and something feels off. You made more than your parents ever did at your age. Yet, somehow your bank account feels emptier than theirs ever was. You're not eating out every day, you're not blowing money on luxury items, and you're genuinely trying to be responsible, but the math still doesn't add up. Every month, roughly 30% of what you earn vanishes before you even have a chance to feel like you earned it. And the strange part is most people can't even tell you where it's going. It's not your income tax. That's the obvious one everyone complains about, the one you see clearly deducted from every paycheck with a label next to it. This is something else entirely. Something quieter. Something built so deeply into the economic structure that you've been paying it your entire working life without ever receiving a single statement, invoice, or line item explaining what it is or where it went. This silent tax has several names among economists, behavioral researchers, and financial psychologists, but the most accurate description is a combination of inflation drag, lifestyle anchoring, and friction costs that operate continuously in the background of your financial life. Most people experience it simply as the persistent, frustrating feeling that money doesn't stretch the way it should, that no matter how much more they earn each year, something keeps absorbing the difference before they can benefit from it. The mechanism isn't hidden because someone is actively concealing it. It's hidden because it operates through dozens of small channels that individually seem insignificant, but collectively redirect a substantial portion of your income away from your control and into systems that profit from your inability to see the full picture. Let's start with the most fundamental layer of this silent tax, which is inflation drag in its true form rather than the simplified version you hear about in headlines. When news reports say inflation is 3%, they're giving you an average across all goods and services weighted by government formulas that may not reflect your actual spending patterns. The reality is that different categories inflate at dramatically different rates, and the categories that consume most of a typical paycheck, housing, healthcare, education, childcare, and insurance, have been inflating at rates far exceeding the headline number for decades. Housing costs in major metropolitan areas have increased by over 60% in the past 10 years in many markets, while wages in those same areas have increased by perhaps 20%. Healthcare premiums have roughly doubled over the same period for many families. Education costs, both for yourself and for children, have outpaced general inflation by 2 to 3 times consistently for 40 years. The mathematical impact of this uneven inflation becomes devastating when you calculate it properly across your actual budget rather than accepting average statistics that blend your expenses with categories you don't even use. Imagine you earn $70,000 a year after taxes, which places you solidly in the middle class in most American cities. And imagine your monthly budget breaks down roughly as follows. Housing takes 35%, transportation takes 15%, food takes 12%, healthcare and insurance take 10%, and various other categories consume the remaining 28%. If housing inflates at 7% while the government reports overall inflation at 3%, your personal inflation rate on that single category alone is adding almost $2,000 per year to your required spending. When you stack healthcare inflating at 5%, transportation inflating at 4% due to insurance and maintenance increases, and food inflating at 6% during certain periods, your actual personal inflation rate might be running at 6, 7, or even 8% annually while you're mentally budgeting as if it were 3. Over time, this gap compounds in the same way investment returns compound, except it's working against you rather than for you. A single year of 5% real inflation on a $60,000 spending base costs you $3,000 in additional required spending to maintain the same lifestyle. Over 5 years, assuming consistent 5% inflation, that same lifestyle now requires approximately $76,000 annually, meaning you need an additional $16,000 in income just to stay exactly where you started. If your income increased by 3% annually during that same period, a fairly typical wage growth rate, you'd have earned roughly $9,000 more, leaving you $7,000 short of maintaining your original standard of living. This is a silent tax in its purest mathematical form. A persistent gap between income growth and cost growth that slowly degrades your purchasing power without any single moment where you can point and say, that's where my money went. The second component of this system is lifestyle anchoring, which operates through psychological mechanisms that evolved long before modern economies existed, but have been weaponized by consumer marketing with extraordinary precision. Your brain has a feature that researchers call hedonic adaptation, which essentially means that any improvement in your circumstances quickly becomes your new baseline for normal. When you get a raise and your income increases from $50,000 to $60,000, you experience a brief period of feeling wealthier, perhaps a few weeks or months, before your brain recalibrates and 60,000 becomes the new normal that feels exactly like 50,000 used to feel. This adaptation served our ancestors well because it kept them striving for more resources in environments where more resources meant better survival odds. But in a modern consumer economy, it becomes a trap that ensures you're never satisfied with what you have and always feel compelled to spend more. The way lifestyle anchoring functions as a silent tax is through the automatic expansion of expenses that follows any increase in income. You get a promotion and suddenly the apartment you've lived in for 3 years feels cramped and outdated. Not because anything about the apartment changed, but because your internal reference point for what someone at your new income level should have has shifted upward. Your car still runs perfectly fine, but now it feels embarrassing to park it next to your colleagues' newer models. So you start thinking about an upgrade you wouldn't have considered 6 months ago. The restaurants that used to feel like special occasions become your regular weeknight options. And new categories of spending that didn't exist in your budget before. Premium subscriptions, upgraded travel, better clothes, quietly appear without any conscious decision to add them. None of these individual changes feel significant in the moment, which is exactly why they're so effective at extracting wealth. Research tracking household spending across income levels reveals a pattern that should disturb anyone who believes earning more will solve their financial problems. The savings rate across income brackets remains remarkably flat, and in some studies actually decreases as income rises. Families earning $200,000 per year frequently report feeling financially stressed and living paycheck to paycheck, which seems impossible until you understand that lifestyle anchoring ensures their expenses have risen to consume their income just as completely as a family earning $60,000. The doctor, the lawyer, the tech executive, and the small business owner often share the same fundamental experience of never having quite enough despite objectively having far more than most. The silent tax collected through lifestyle anchoring doesn't care about your income level because it's calibrated to extract a consistent percentage regardless of how much you earn. The third layer of this extraction system involves what economists call friction costs and what ordinary people experience as the constant nickel-and-diming that accompanies every financial transaction in modern life. These are the subscription fees you forgot you were paying, the service charges on bills that used to be flat rates, the convenience fees for paying online, the processing fees for transactions, the insurance deductibles that keep rising, the maintenance costs that somehow exceed estimates, and the thousands of small amounts that exit your account so quietly you need forensic accounting to track them all. Individually, each friction cost seems too small to worry about, which is precisely why they're so effective at accumulating into substantial annual sums without triggering your financial alarm systems. Consider the subscription economy alone, where the average American household now pays for between 10 and 15 recurring subscriptions across streaming services, software, apps, memberships, and automated deliveries. Each subscription is priced at a point designed to feel negligible, usually somewhere between $5 and $20 monthly, because consumer psychology research has identified the precise thresholds below which spending doesn't register as significant. But 10 subscriptions at an average of $12 each equals $144 monthly or over $1,700 annually. And that's before accounting for the annual price increases that each service implements, knowing most subscribers won't notice or won't bother to cancel. This is extraction by 1,000 small cuts, each one too minor to resist individually, but collectively representing a meaningful percentage of most people's discretionary income. Now let's examine the opportunity cost dimension of the silent tax, which might be the most expensive component of all, because it doesn't just take your current money, but takes your future money as well. Every dollar that exits your control through inflation drag, lifestyle anchoring, or friction costs is a dollar that cannot be deployed into assets that grow over time. The fundamental mechanism of wealth building is putting money into investments that compound, meaning they generate returns that themselves generate additional returns in an accelerating cycle. When you lose $300 monthly to various silent tax mechanisms, you're not just losing $3,600 per year. You're losing what that $3,600 would have become over decades of compound growth. Let's make this concrete with actual numbers. If you could redirect $300 per month from silent tax leakage into an investment account earning an average 7% annual return, which is below historical stock market averages, after 10 years, you would have accumulated approximately $52,000. After 20 years, that same monthly redirect becomes approximately $156,000. After 30 years, roughly the span of a typical working career, you have accumulated approximately $364,000 from money that was otherwise disappearing without your awareness. This is a true cost of the silent tax. Not just the dollars it takes today, but the exponentially larger wealth it prevents from ever existing in your future. The psychological architecture of this system creates a particularly cruel feedback loop because the financial stress caused by the silent tax actually impairs your ability to recognize and resist it. Researchers studying financial decision-making have documented that monetary stress reduces cognitive bandwidth, shortens planning horizons, and biases choices towards short-term relief rather than long-term optimization. When you're feeling squeezed financially, you're more likely to make impulsive purchases that provide immediate emotional comfort, more likely to choose convenience options that cost more but require less mental energy, and less likely to invest time in tracking expenses, comparing prices, or optimizing your financial systems. The silent tax creates conditions that make you more vulnerable to paying even more of it, which is why escaping this cycle requires conscious intervention rather than simply hoping things will improve as you earn more. Understanding the mechanics of the system is the necessary first step toward architecting around it rather than being captured by it. The initial move is to calculate your personal inflation rate by tracking your actual spending across categories over a 3 to 5 year period rather than accepting government averages that don't reflect your life. You may discover that your real inflation exposure has been running 2 to 3 percentage points higher than reported figures, which means your required savings rate to maintain purchasing power is also higher than conventional advice suggests. The second intervention is to implement what behavioral economists call pre-commitment devices, which means automating your savings and investment contributions before you receive spendable income so that lifestyle anchoring can't access those dollars. If your savings rate is determined after your brain has adjusted to a new income level, lifestyle anchoring will always win. If your savings are extracted first, lifestyle anchoring can only work on what remains. The third and perhaps most powerful intervention is a deliberate reframing of what wealth actually means and how it's actually built. The consumer economy relentlessly promotes a vision of wealth as lifestyle, as visible consumption that signals success to observers, because this definition of wealth is what generates the spending that profits depend on. But actual wealth, the kind that creates security, options, and eventual freedom from mandatory work, is built through ownership of productive assets rather than consumption of depreciating goods. Every dollar that goes toward lifestyle maintenance is a dollar that doesn't go toward buying assets that generate income, appreciate over time, or provide optionality in how you live. This isn't about deprivation or extreme frugality, but rather about consciously choosing which game you're playing. The consumption game where you work to spend, or the ownership game where you work to acquire. The economy has currently structured benefits enormously from your participation in the consumption game, because your spending is revenue for corporations, jobs for workers, and taxes for governments. There's nothing conspiratorial about this. It's simply how a consumption-driven economic model functions. But it does mean that powerful forces are aligned toward keeping you spending everything you earn rather than accumulating wealth that would eventually make your spending optional. The silent tax is a mechanism that ensures this outcome by extracting a percentage of income growth before it can be converted to wealth. And it works so effectively because it operates below conscious awareness. But awareness is exactly what breaks the cycle. Now that you understand the 30% that's been vanishing, you can stop paying a tax that never appeared on your pay stub, was never authorized by any law, and benefits everyone except the person paying it.